Hey, what is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and I just wanted to do a quick video with a mortgage rate update here today. The Federal Reserve just announced that they have increased the federal funds rate by 0.75%, and I want to show you what happened here in the mortgage market. So if you are new to the channel, go ahead and hit that like button, hit that subscribe button if you like all things finance, real estate, and investing. And without further ado, let's get right to it. All right, so up on the screen here, I have the CNBC website. I'll go ahead and link to it below, but the best way to figure out what is happening with mortgage rates, in my opinion, is to go ahead and click on the bond tab here. Then you want to go ahead and click on the US 10-year Treasury yield. And this is really going to show you what is going on in the mortgage market. Now, for those of you who do not know, mortgage rates generally tend to track the 10-year Treasury yield. In other words, if the Treasury yield goes up, mortgage rates rise. If the yield goes down, then mortgage rates tend to follow. Now, this right here on the screen is a one-year chart, but I want to show you what is happening within the last 5 days. The Federal Reserve just announced the 75 basis point increase yesterday, and I want you to take a look at what has happened. All right, so now up on the screen is a 5-day chart showing the 10-year Treasury yield, and as of yesterday, when they made this announcement, the actual Treasury yield dropped significantly. So it was hovering at about 2.8%, and it immediately dropped to about 2.67%. And today it is hovering at 2.671. So what's really interesting about this is that typically speaking, the 10-year Treasury yield, it doesn't follow in lockstep fashion with the federal funds rate, but it does tend to track it. And sort of the opposite happened here. It kind of decoupled. Now, this is an indication that investors are putting more money in the bond market. When bonds go up, their yields go down. And that could be exactly what's happening here. So lots of folks are talking about higher mortgage rates, but that's just not what is happening here at the moment. So now let's switch gears a little bit and talk about the national average for 30-year fixed rate mortgages. Up on the screen here comes directly from the Freddie Mac website. I will link to this in the show notes. It is updated every Thursday. Last week, the average was 5.54% for a 30-year fixed. And you can see just in the last week, this has actually dropped down to 5.3% on a 30-year fixed mortgage. That is with approximately 0.8% in fees and points. What they're talking about here is the cost in order to secure that rate as a national average. In other words, if you have a $100,000 loan, on average to secure a 5.3% 30-year fixed rate mortgage, it would cost you $800 in points to get it. Now, it's relative to the loan size. So if you have a large loan amount, it's going to cost you more. Now, the average 15-year fixed rate mortgage is coming in at 4.58% with just under 1% in points as well. And then of course the 5-year adjustable rate mortgage is coming in lower than all of these at 4.29% with a fee structure of 0.3%. So you can see just by looking at this chart here, rates sort of peaked out at about 5.8%, and that was as of about a month ago. So rates have been coming down for the last month or so, and they're hovering in the low 5% range today, depending on how you qualify. This is just an average. So talk to your mortgage lenders, talk to your brokers, those of you who have purchased, let's say within the last 60 days or so. Well, over the next few months, you're gonna wanna continue to monitor this because there may be an opportunity to reduce your rate and lower your monthly payment. All right, so there you have it. That is the mortgage rate update for this week. Mortgage rates are trending down at this point, which means the cost to borrow is becoming more and more affordable. Now, it's obviously a far stretch from where we were at the beginning of the year, where interest rates were hovering at around 3%. So the cost to service the debt today is still on average, at least in my market, probably about $500 to $600 higher per month than it was in January. All right, so that is gonna do it for today's video. If you haven't done so already, please hit that like button, hit that subscribe button if you wanna see more videos just like this, and we will see you next time. Take care.